looking for trends is something which everyone does. Whether you use fundamentals, whether you use technicals, whether you're a long-term investor, whether you're an intraday trader, whether you're an algo trader, it is in trends that we ultimately make money. And I've been very fortunate to be associated and having known Mr. Rakesh Jhunjhunwala for more than 14 years, and out of which for 12 years I've worked with him at Rare Enterprises. I'm going to share this knowledge through 6 parts. The first is why I look for mega trends. The second is how I find stocks with trending earnings. Third is how I find stocks which have trending prices. Fourth is how I'm really able to combine these two diverse thought processes into my own model. Fifth is the pain and pleasure of riding a trend. And finally, in the 6th part, I will share with you my exit strategy. The marketplace around us has a lot of noise, starting right from your mobile phone. Then it's your television set. Then it's the friends. You have to be able to manage your environment in such a way that it supports your investing style. Hi, I'm Atul Suri. Come learn trend investing with me.
In 1886, this pharmacist invented Coca-Cola. He sold only 9 glasses a day for 5 cents each. But today, Coke serves 1.9 billion servings every single day. Just imagine the mega growth, the mega trend. Look at this. If you had invested in Coke in the year 1988 and held on to it till 2019, you would have made a massive 1,500% on your money. This is known as a mega trend. You may have ups and downs, but in the end, the stock price would increase and would leave you with a pretty decent return. Now, Warren Buffett saw this trend. And it's not just limited to him. Super investors look for mega trends which would help them attaining massive wealth. They could be Rakesh Jhunjhunwala, for example, with his investment in Titan. He started his journey when the price was at 3 rupees, but in 2019, it's almost 1200, giving him a return of 40,000%. Ooh la la. Although these are periods of ups and downs in the stock, this was again a mega trend. Atul Suri, who's worked with Rakesh Jhunjhunwala closely, has been part of many other success stories like Titan. He'll teach you guys about what he knows about finding mega trends using his own take on the CANSLIM model. He's going to talk about
the first is why I look for mega trends. The second is how I find stocks with trending earnings. Third is how I find stocks which have trending prices. Fourth is how I'm really able to combine these two diverse thought processes into my own model. Fifth is the pain and pleasure of riding a trend. It seems like the easy part, but believe you me, it is a long journey which can be very tedious. And finally, in the 6th part, I will share with you my exit strategy and the ruthlessness with which you have to execute it. This is the big pain point for most investors. Hi, I'm Atul Suri, CEO and CIO of Marathon Trends PMS. as I take you through my journey of identifying stocks with trending earnings and trending prices and how to profit from these mega trends. Apart from sharing with you my model of identifying stocks with trending earnings and my model for identifying stocks with trending prices, I will also share with you my exit strategy, which is really the most difficult part of the equation. I joined the equity markets in 1990 with Parag Parikh.
Well, I'm not a professor. I started my career as a stockbroker.
Parag Parikh was the first Indian broker to start fundamental equity research, and I was very fortunate to learn at his feet. As my career moved on, I got in the area of institutional sales and I worked with Birla Sun Life Securities. And I've been very fortunate to be associated and having known Mr. Rakesh Jhunjhunwala for more than 14 years, and out of which for 12 years I've worked with him at Rare Enterprises. Ultimately, every investor is looking for a trend. At one end of the spectrum, you have somebody like Warren Buffett who invests for years. On the other end of the spectrum, you've got a day trader whose time frame may just be a few minutes, or maybe even an algo whose time frame may be just a few seconds. What they are doing also is trying to determine the price pressure on the screen at that point in time. So looking for trends is something which everyone does. Whether you use fundamentals, whether you use technicals, whether you're a long-term investor, whether you're an intraday trader, whether you're an algo trader, it is in trends that we ultimately make money. Therefore, trends has nothing to do with time frame, and it has nothing to do with your style. Ultimately, money is made in trends. And this does not only restrict itself to equity. This goes across asset classes. In equity, I spoke about, even if you're looking at investments in debt, what are you looking to look for? Trends in interest rates. If you're looking at currencies, you're looking for trends there. If you're looking for any other asset class, even for that matter, real estate, which may not be a screen-based trade in India, what people are looking for, trends in prices. In fact, one of my biggest education in life has been a stock called Titan. All know about it, and you know the legend of Rakesh Jhunjhunwala.
Rakesh Jhunjhunwala invested in Titan in 2004. He bought 10% of the company with 18 crore rupees. Today, the same stock investment is worth $1 billion.
What is the common trait with these stocks? The common trait I found is that these stocks have two things in common. That means their earnings tend to compound year on year, quarter on quarter. And this is really what gets rewarded year on year in terms of pricing. And it is this consistency of earnings is really what leads to stocks compounding and creating great returns. This is the logical way which most people do. I also found a very interesting inversion to this whole theory. It is that trending prices very often give you a signal to trending earnings. See, there are over 5,000 stocks in the Indian market and nobody can cover all of them. There are so many sectors, you cannot have the expertise in all of them. So what you really do, or what I do, is really scan the market. And wherever I see prices that are trending, stocks that are performing as per my parameters, I go and look below the hood. And very often you see the makings of stocks which have also very good earnings. Let me give you an example. In 2014, tile manufacturing stocks were making new highs and you started seeing excellent volumes. And tiles as a sector was hardly covered by any analyst, or it was hardly a sector at that stage. That it was not just one stock. You had Cera, you had Kajaria, you had Somani, you had so many other stocks which were actually trending beautifully.
In fact, the entire ceramic industry was growing at a very fast pace in 2014, with all the production shifting from Europe all the way to Asia. Now, India had become the third largest manufacturer in the entire world. It wasn't only the fact that the production had shifted. India was actually innovating in the segment with the introduction of new products like 3D tiles and germ-free tiles and even artistic designer tiles. If we look at the biggest companies in the segment, and we're talking about Kajaria and Cera, etc., Kajari was growing at about 43% year on year for the past 3 to 4 years, and same in its profitability. Sera also was growing at the rate of 21% year on year, which is really high for a market leader, which means that the market is growing aggressively. Slowly, all the institutions saw this, and there was a sudden high momentum in their stock price. Now, this shows that companies grow their earnings year after year, the price of the stock would also increase, making a direct correlation between earnings and the price trend.
And when you went in and looked at the earnings, you realize that, hey, there is something very big happening here. This gives you very good opportunities. So this is something which I've experienced in the last few years with another sector, specialty chemicals. Again, you start seeing a sector which is not very much covered by analysts. You'll find that there was very little volume in these stocks. However, you started seeing build up in volumes and prices. No one was analyzing them. But based on price movements, I was wondering, what is it that is going on here?
What does makeup and washing powder have in common? Well, it's the fact that both of them require special chemicals. Traditionally, this was captured by developed parts of the world like the European Union and the United States. Together, these two countries contributed 40% of sales until 2008.
ये भारी गिरावट 200 पॉइंट नीचे खुला है निफ्टी फिलहाल 3311 के स्तर पर तो जिस
The Great Recession changed everything. Businesses started shifting from the developed nations to markets like Asia. I mean China, right? They started getting control of the market. Chinese workers cost far more than Indian workers now. Check this out. So businesses then shifted from China to woohoo, India. Specialty chemicals grew in our country and companies in these segments started seeing an increase in profitability. So let's first look at the earnings of companies in this segment. Let's open up Atul Chemicals first, its P&L statement. Now you'll see here that there is steady growth in its numbers. So every year the earnings are increasing. So as you know, when earnings increase, what do you think are happening to the price trends? Let's have a look. The chart clearly shows that this segment, at least this stock, is also moving up, just like its earnings. We can clearly see that because the trade of specialty chemicals shifting to India, there's an increase in volume. Therefore, there is a clear bull run that we can see here. Now, this is the same case with other stocks too in this category, like Vinity Organics, Aarti Industries, etc. You should check out those P&L statements and compare it with historical prices to see if there's any correlation. You will find that most of the time there is a correlation.
In the earlier chapter, I shared with you why I look for mega trends. Let me now get into the how. The first step, or what really sets mega trends, are trending earnings. What are trending earnings? Trending earnings are nothing but stocks that continue to have EPS growth year after year. This is the first method. And here, I was actually very influenced by a model called CANSLIM. CANSLIM, C-A-N space S-L-I-M, actually has two parts. The CAN part is the earnings part and the SLIM is the price part. This was, of course, put out by William O'Neill, a legendary investor, and we really associated very strongly with the CAN part. The SLIM part, which is more the price related elements, is something we found a little difficult to follow because it was very subjective. And in my model, I like to have quantitative and fixed parameters. So let us visit the C part, which is current quarterly earnings. Companies report earnings quarter after quarter, and this is really the sum total of 4 quarters give you a year. But this gives you a very good insight as to the progression or what sort of path the stocks or the companies are taking. So here we look at not just the earnings, because earnings come as a result of many other variables. So we do a deep dive and look at 5 principal variables which give us an understanding of how the company's business is growing. The 5 variables are, firstly, sales growth. We love companies that are growing in sales, because very often companies grow in profitability, but if there is no sales growth, sooner or later, they are unable to deliver that kind of numbers. So a good sales growth is the first important area. Second is we look at operating earnings. This really talks about efficiency of the core business. Third is profit after tax. Obviously, a number which we are all obsessed with and which definitely gives us a lot other ratios in terms of valuation also. Fourth is what we look at is margin expansion. Margin expansion also gives us a sense of how the products of the company are being accepted and how things are going to pan out ahead. And finally, return on equity. Do we give it a fixed growth rate? The answer is no. What we do is we look at the rate of change. What I mean by rate of change is how these parameters are progressing quarter on quarter. So we like to see companies which have an accelerating or has an acceleration in these 5 parameters, which gives us a sense of how the business is doing. This is really what I call getting under the hood. I'll give you an example of something like Bajaj Finance. It's a marquee name today. What you could really see from the numbers in the spreadsheet are how you will see an excellent acceleration in most of these parameters. And this happened not just one-off in one quarter, it happened in quarter after quarter. And this gave us a sense of a stock which had the possibility of being a compounder. A similar example you can see is something I found in Aarti Industries. Aarti Industries was again a little known stock in a very niche segment, specialty chemicals, which I spoke about earlier. But what you will notice is that Aarti Industries also started reporting great improvement in all these 5 parameters. And this happened YOY, quarter after quarter. And this got supplemented with price movements, which gave us a sense of a mega trend. The second part of the CANSLIM is the alphabet A, which is annual earnings. We look at companies with minimum 3 years of earnings. When you find companies with 3 years of consistent growth in earnings, you get a sense of a trend that is sustainable. You just do not want a trend, you want a sustainable trend, because that's how you're able to ride it for the long term. That's how the whole power of compounding gets in. That's how you create more wealth. What is our measure of positive earnings? Do we have a fixed number that a company should grow at 5%, 10%, 20%? The answer is no. I think it is a very, very variable number. We plug in a number based on the industry and the environment it is. As I said, that each industry has a different growth rate. You cannot link what an IT company is doing with a FMCG company or what a bank is doing with some sort of capital goods sector. It's very important to be able to appreciate and understand the growth rate of a sector. Also, if we look at the broader economy, the growth rate or the benchmark for growth rate in an economy that's growing at 2% will be very different if the economy is growing at 10%. So looking at 3 years of earnings is not a fixed number filter, but it is very variable, and that is what we plug into our method. So the question that very often comes to me that are you not late in picking up a stock or a company because you are looking at 3 years of earnings? Yes, we are okay to enter a stock a little late. What is important is the steadiness and upward trajectory of a trend. Let me give you an example of a stock. HDFC Bank, I guess the most widely owned institutional stock. It does not matter if you did not get into HDFC Bank at the IPO or very early. At whatever stage you got, it is because of the trending nature of its earnings, the trending nature of its price, you still went on to create more money. The path of compounding is not just about picking bottoms, picking multi-baggers. It is being able to compound consistently, and very often it's all about not making big mistakes. The third part of CANSLIM, the N part, is the new factor. Now this is what I call almost like an X factor. Yes, we can capture most things numerically, but some things are also qualitative. And I found that stocks that ultimately create a lot of wealth always have some X factor. And I look for them in three categories. First is a new product. Let's take the case of Eicher Motors, another legendary stock, a great wealth creator. They manufacture a bullet motorbike, which was a very old and outdated piece of technology, which was very rural in its focus. However, the technological upgrades, you really had a new bike which had much superior performance and great appeal. In fact, you started having a waiting list for a bike of 3 months and more. And that really gave us a sense of here is a new product. And when you have a new product which becomes a hit in the market, it will surely lead to, as we pointed out earlier in the 5 factors, which is sales growth. You will see great operating performance, you will see margin expansion, and so on and so forth. So a new product is always a very good trigger for a starting point of identifying the potential long-term trends. The second area is change in management. Companies and managements get jaded, and at times there is a need for shake-up. We see that recently with some of your commercial banks. Look at Axis and ICICI. Great banks, great institutions, but they ran into a bit of problems. And what you saw was fresh blood coming in here, new managements coming in, and what you see in terms of earnings and price after that is there for you to see. So new managements also very often put a lot of life into old companies, and they become triggers for stocks, companies, and earnings to start new trends. The third is industry dynamics. Very often a lot happens at the macro, which changes the fortunes of an industry. As I told you, there are 5,000 companies, and you cannot sit and monitor however large your research team is 5,000 stocks. And numbers do not come every day. They come once a quarter. So you run filters at periodically and are able to almost filter out those stocks which really have outstanding characteristics based on these 3 parameters. And this really helps us to know which space of the market or in which stocks we have to be in. There are a lot of websites where a lot of data is available freely. You can look at something like screener.in, or even Capital Line has, and even the softwares that are paid for are available at negligible prices. And the beauty in that is that you can customize your own filters, you can customize your own parameters and run a scan and be able to pick such stocks. The important part is not data. There is a lot of data. The important part is not companies. There are a lot of companies. It is your ability to create a model that works for you. All these websites also have an option of downloading this data into Excel. Once you download this data, you're able to rank it and then look for the newness. The newness obviously is a variable which is based on your judgment, as I call it the X factor. But in our world around, it's very easy for you to walk up to a store and experience a product. If you enjoy the experience, if you see something fantastic happening out there, you know that what rank you have to give it in your big spreadsheet. Let me talk about a very important filter, and which is one of the most important risk management tool in today's markets. It is volume filters. In our market, I have observed over the years, in every bull market, people get sucked into a lot of stocks which may give you liquidity at a price while entering but do not give you exits. This is where the maximum loss is incurred by investors. The biggest damage I have seen in portfolios of investors over the years is this space of stocks which are illiquid. It's not that you do not know you have to exit a stock. A lot of stocks do not give you an exit. In fact, as recent as the 2008 October time, when you had a bit of a meltdown in small and mid-cap stocks, what you saw were great euphoric stocks in the up move, which were in limit down, and people did not get exits. Once you've ranked the stocks on the basis of volume, make sure that you do not want to have so much holding that you do not get exit of your position in a day or a few days. Essentially, you avoid those stocks which are very low in the ranking. And remember, in an up market, every stock, the volume or value traded is in the downtrend. So be careful of this trap that a lot of retail investors get into. I shared with you earlier the CANSLIM indicator, where CAN part we have spoken about earlier. But let's go into the second segment. I do not do the SLIM section, but I have my own acronym for it. It's called SMV, where S stands for smoothness of price trends. M stands for momentum, and V stands for value. Now let me dwell on each of these three. So first, let us take S, which is smoothness of price trend. It's very easy to know a trending price, right? You can do the stocks that are the highest gainers for a year, for a month, 3 months, 5 years, depending on whatever is your time frame. But just pure price movement is not important. It is very important that this journey should be smooth. It is very, very important because as an investor, it is much easier to ride stocks which have smoother trends rather than very volatile trends. When the price trends or stock price behavior is very volatile, your psychology is going to get really tested. What's going to happen is when a stock is up 20%, your greed is going to make you buy it. And when the stock goes down 20%, your fear is going to set in and very likely you are to sell it. So look for stocks which do not have such high volatility, but which go up at a very gradual pace. Because in these stocks, you're more likely to stay with the investment for long periods of time. That is why I give a lot of emphasis not just to price moves, but smoothness in price moves. We can take an example of HDFC Bank. One of the reasons it has been a part of most people's long-term portfolio is not only that it has rewarded, there have stocks that have rewarded more. However, the trend of HDFC Bank is very smooth. This is a stock that honestly does not give you sleepless nights. If stocks give you sleepless nights, you have to understand that it is too volatile or not good for you. So look for stocks which have low volatility in an uptrend. And that is my first filter. What I'm trying to say is, and I want to repeat this, is that when markets correct, it's very important to see the behavior of a stock at that point in time. Stocks that correct less, and when markets turn around, they become leaders or they break out first. These essentially are leaders. That characteristic was seen in pharma stocks. In 2008, we had a total sell-off in markets. Even pharma stocks got sold off. But you will find that the percentage of fall in this space was very limited, coupled with the fact that their earnings were improving. And when the markets turned in 2009, the first set of stocks or first sector to break out into new highs was pharma. And this was the making of a sector that led the markets from 2009 to 2016. You almost had a 6 to 7 year bull market in pharma, and purely by studying the behavior of pharma in the correction of 2008 and first breakouts in 2009 gave me a sense that this is a sector we have to be overweight. And that was a beautiful trending ride you had for 5 to 6 years after that. This is an essential hallmark of stocks which have the capacity to be mega trends. So as I like to very often jokingly say that I like to do my research in falling markets, because that's when the true test of a stock behavior is. That is when quality stands out. And you'll find a lot of stocks in this category. We spoke about HDFC Bank. Just have a look at it. In the consumption space, FMCG phase, you will find a lot of such stocks. Have a look at Britannia. Have a look at Asian Paints. Berger Paints. And there are so many such stocks where you'll find smooth trends which didn't give you heartburns or sleepless nights. They may not be the most exciting, they may not be the most fastest stocks, but sure, they are the greatest wealth creators. Looking for excitement in our stock market is very expensive. Look for unexciting stocks which are in long-term trends, but more importantly, these are the compounders, these are the wealth creators. The next area we cover is M, which is momentum in price. Obviously, momentum in price is very obvious, and that's what we all look for. But what I really want to bring out at this stage is the correlation or the overlap that you saw in the earnings model and in the price model. We almost have a one-to-one correlation or correspondence. In this area, what I talk about momentum, this really overlaps with my area of quarterly earnings.
Look at these two stocks. Both have the same number of shares traded. It's also called volume. Now you have to tell me which stock has more investor interest. Okay, I'm waiting. Okay, let me help you out. Let's add one more piece of information, delivery volume. You see, this stock has 40% of its volume delivered to people. And this means investors wanted to hold on to the stock for whatever reason, but 40% investor interest was there. The other stock is just the opposite. Traders traded, but nobody has any long-term interest, at least for this particular trading day. Delivery volume tells us the total volume of stocks delivered to the actual buyer. So take a look at this. You'll see Adani Enterprises has a delivery volume of 10.6% and its 5-day average is 14%. But take a look at, say, Uniphosphorus Enterprises. Its 5-day average is 64%. Well, almost. This means that there is more long-term interest in Uniphosphorus, at least for these 5 days, versus Adani. Now, this doesn't mean that you should buy Uniphosphorus, not at all, but this gives you an indication whether the stock that is being traded is more for trading purposes by traders, or is there investor interest. It's one nice little tool to add to your investing arsenal before you actually decide.
So what you see is that companies with consistent quarterly earnings also start seeing excellent momentum in prices, because we are not interested in just getting into a long-term trend which may be peaking out. So we also like to look for momentum in earnings, and this momentum in earnings in the medium term also very often gives us a clue as to something big that is happening. Let me give you a few examples. We spoke about Axis Bank in the X factor, change in management. What you really started seeing was excellent price behavior and momentum in this bank. And when you started looking at the price behavior, you realize that, hey, there's something more happening here. And this gives me a sense as to what is changing in the earnings space that is causing this kind of momentum. SRF, another stock which we like and which is in the specialty chemical space. It is price momentum in the medium term which gives you a sense that there is a possibility that something is happening in the other bucket. So the beauty of our model is this overlap. A lot of people have very good models in bucket 1 or bucket 2, but it is this ability to overlap these parameters is really what gives you the edge, and which gives you a very simple process. In the end, it gives you a very simplistic result, which is very easy to follow. The third factor that we look in identifying trending prices is value. I'm not saying volume, I'm saying value. This differentiator is very, very important, because you will see stocks, especially very liquid stocks, especially the trading element, having very large volumes, but deliveries at the end of the day are minuscule. So money flow, which is a very important determinant of trends, it acts as a confirmation, can be determined not just from volume, which is very commonly looked at, but value of delivery. This really gives great insight and a great trigger as an entry point for getting into stocks. This very often also coincides with the new factor that we mentioned earlier. There is a new breed, a new category, new investment section that is getting into a stock, and this very often creates re-rating in stocks, and that I think is a very good entry point, a trigger point. I will give you two examples of stocks which have seen an amazing spike in delivery value and which gave you very good entry points or triggers to tell you that something special is happening here. Here, look at the chart of Bata and look at the delivery value. Next, look at the chart of Bajaj Finserv, and here, look at the delivery value. At these points, you clearly understood that something special was happening. Something special is happening in the product front, or is it the management front? Or is it some other newness or factor which is bringing a new class of investors who are betting on it? Ultimately, it's all about demand and supply. When there is genuine demand, which is delivery value, you realize that this becomes a trigger point for the stocks to trend higher at later stages. Delivery volumes are easily available on the NSE site. And also there are a lot of softwares, price-related technical softwares, which give you delivery percentage as an indicator. If you plot that indicator, you can very beautifully look and find stocks where there are spiky volumes. Remember, it's not just one day. We are looking about weeks and months, and that is really the making of long-term trends. We spoke about trending earnings, we spoke about trending prices and the variables that go into these models. The challenge is that very few people believe in blending them, or they are able to do that, because the market is very divided between two categories of people. People who look at earnings, which is essentially the fundamental guys, and people who look at price, which is essentially the technical guys. And there is always a bit of a clash here. This category of people think these guys are no good, and this category of people think these guys are no good. And I think that's an absolute waste of time. Our summation is nothing but bringing both these models together and ranking all stocks. So I just want to repeat the whole system as it stands. First and foremost is the value filter. We do not, or we eliminate all stocks which have such low volumes which does not give an exit. Then in the earnings phase, I mentioned about CAN. We look at companies with accelerating quarterly earnings, consistent annual earnings, and a new factor. And on the other side, the three variables, which is all about a smooth price, it is about momentum, and it is about delivery value. We combine all these factors and come up with a composite ranking.
There are multiple ways of creating a portfolio, and I'm going to show you how you can do it, at least one way. The very basic one is equi-weighted. So let's say you have 10 lakh rupees and you have 10 companies, you'll allocate 1 lakh rupee to each company. Now let's move to the actual filtering criteria using the CAN SMV model. And for this, I'll use a website called TickerTape, but you could use any screener really. You could use Excel. It doesn't really matter. Now, the first thing you'll do is apply a filter, and I will use EPS growth. That's the 5-year EPS growth. And what we'll do is we'll change this to 20% minimum. So obviously any stock that is not growing above 20% will not show up here. Now we have 333 stocks which have grown at 20% over this time. Pretty nice. Let's add the next filter, and that's 5-year revenue growth, and I'll change this to 25%. Now this will be added, and now I have only 243 filtered out. The next filter will be the 5-year average operating profit margin, and I'll change this to, again, 10%. The minimum operating profit margin we'll take as 10%, but after that we look at net profit margin, and you could change this to 15% as well. But you should decide what this number should be. I'm just choosing an arbitrary number just to get you an idea of how this works. So let me add one more, and that's the average ROE. Again, I'll choose the 5-year return on equity, and we'll change the number to say 10%. Here we go, 10%. And revenue growth, I forgot to change this to 20%. Now we have 106 results. We have some filtered stocks. Wonderful. Now I could also add a market cap, minimum market cap that I want. So let's say we go for only stocks with a minimum market cap of so much, and you'll get only 7 results. You could obviously change this to maybe mid cap, and for mid cap you'll get 23 results. The point is, you're able to filter from the universe and find a list of stocks that meet your criteria, and then you just go from there. Now remember, what I've done is a very broad universe, and we've brought it down to a few dozen companies. But when you're preparing a portfolio, what you need to do is take one sector and choose that sector's revenue growth, ROE, EPS for each sector, because it will be different. A bank's ROE might be very different from, say, an FMCG company. So you need to run this sector-wise to find those stocks and then create a single portfolio. So when you actually do this, you'll have to spend a lot more time than I just have, but now you know how to actually do them.
You will find that at the top of the list, very easily are placed those stocks which have excellent earnings growth and excellent price growth. And voila, this is exactly what we are looking for. These are mega trends. Now let us get into the area of a portfolio construct, how I do it. I essentially like to limit myself to 20 stocks because I feel over diversification just dilutes all the work you've done. I need to be in such an allocation that if the stock moves, it should have a meaningful delta. So what's the ideal number? I guess there is no such answer to me, but I am very comfortable to a max up to 20 stocks. And what's more important is I do an equal allocation. That means my bet size per stock is equal. By the 80-20 principle, through my mathematics, I have found that even if 20% of my stocks work out to be mega trends, I'm more than sorted for. So the 80-20 principle holds true for in this world of investments. In fact, when you look at all great investors, you realize it's not the strike rate. A lot of people are obsessed with strike rate. It's not the strike rate. The important thing is that are you meaningfully allocated in a stock? Just brings us back to the line by George Soros, which is such a gem. It doesn't matter how many times you're right or how many times you're wrong. What matters is how little you lose when you're wrong and how much you make when you're right. And remember, not all your investments are going to be successful. Skew the mathematics in your favor in such a way that even if 20% of your investments work out, it gives you fantastic returns. That is the 80-20 principle. I believe in this 80-20 principle, not just in markets, also in life. Please read up on that. It's a great philosophy, a great thought process, which I strongly believe in. And that is what I build to the construct of my portfolio. Now the question that comes up is, what is your time frame? This time frame also leads from the earlier point that winners are held for years because they have smooth trends and there is no reason to upset them. You just have to sit and ride them. However, with losers, you have to be impatient. In spite of all your research, you may find that suddenly, due to some factors which are beyond your control, beyond management controls, micro, macro, because the variables affecting a business are so many that the numbers are no longer coming, or the price trends are breaking down. You must have an exit methodology, which is something I'll talk about later. However, whenever we exit losers, those holdings are for shorter time frames, shorter periods. So, just as risk-reward ratio is about losing little and earning a lot, even it overlaps with the time frame that whenever you have losing investments, always the holding period is short, and whenever you have winning investments, the time horizon is long, which runs into multiple years. So this really is the mathematics of a portfolio construct. Have a focused portfolio, have a number of stocks which you can monitor actively Work and believe in the 80-20 principle. Skew the mathematics in your favor in such a way that even if 20% of your investments are correct, you will still have outsized returns, and this will overlap with your time frames. Because ultimately, all wealth creation, or the richest people in the world have been people with concentrated portfolios. Look at Jeff Bezos. It's a single stock portfolio. Look at all other people, legendary investors in India. Ultimately, it is few stocks that have really moved the needle. And do not be nervous just because a stock has done very well and become an oversized part of your portfolio. You need to trim it, because in your life, you're going to have very few such mega trends. And when they come, milk them, and milk them hard so that they make an appreciable change in your wealth meter. Now let's get to the pleasure and pain of riding a trend. The pleasure, obviously, is that when you have a trend in place, a mega trend in place, you make money, and that's a very joyful experience. But even riding a trend can be very painful, because in this journey, remember, not every year is profitable, not every month is profitable, not every day is profitable. And at each phase, when you realize that you are underperforming, you start questioning yourself. Your monkey mind starts thinking of alternatives. That, okay, this stock is in a trend, but I think that it will be flattish for the next 3 to 6 months. I should probably sell this and buy the other one, which seems to have more momentum. And when I make money in that, I will sell that and come back. That never happens. So patience is an intrinsic quality of trend investing. The qualitative angle is very, very important. The mathematics can be learned from books, from people, but the emotional fit is very, very important. So sometimes people ask me, why do people day trade? Why do somebody invest? I think it's so linked with your personality. Understanding the emotional side of any investing is very important. You have to have an investing style that fits your personality. You have to have belief in your method, in your strategy, in your stock. Without that, you cannot last the full journey. It's not that you just do nothing. You have to keep monitoring it. You have to have processes. You have to have the discipline to look at your investments and monitor. There has to be a method to it. The marketplace around us has a lot of noise, starting right from your mobile phone. Then it's your television set. Then it's the friends. You have to be able to manage your environment in such a way that it supports your investing style. Especially when we are going through points of difficulty, self-doubt, which is the perseverance stage, having a supportive group of friends is very, very important. So this is really the joys and the pains of riding a trend. As I said, every day is not a good day. However, at the end of the journey, the joy is tremendous. Final class is the ruthlessness of exiting. One exits an investments in 2 stages or 2 parts, which is 1, you exit at a profit. That means you take profits, and at times you have to also book at a loss. As I said earlier, it doesn't mean that in spite of all your analysis, everything works out. Your ability to exit your losses is very, very important. And most people have a lot of difficulty in booking losses is because of your ego. You just do not accept the fact that how can I be wrong? So it is very important to be able to exit your losers. And I have learned this in a very hard manner. This was the 2000 bull market, which was an IT bull market. We all made a lot of money in that space. And in 2008, the market fell. It fell sharply. However, post the early fall, there was a sharp bounce back. And here, I really liked a stock called Mastic. I got into it, got into a sizable position. At that stage, when you made a lot of money in a bull market, you tend to be a little arrogant. However, due to the volatility of that market, Mastech, along with the market, again started falling. And I had a trigger for an exit. However, I felt I should give it one more day. And my ability or reason to give it one more day is, as I said, I was sitting on very large profits in the 2000 bull market. Also, it leads to a bit of arrogance. It leads to a bit of ego. And I decided to give Mastech one more day. I said, no, we'll not exit today. Kal dekhte hain. We'll see tomorrow. And what happened the next day was Mastech opened in down circuit. And the stock went into 5 down circuits after that. The stock lost 50% without an exit for me. And the hit I took in my portfolio is something I can never forget. This really put the fear of ruin in me. How one mistake can create so much of a drawdown in your portfolio was experienced by me in Mastech. And that pain has never left me. So when I say exit is very important, because remember, if you do not exit, you run the risk of ruin. And there are many examples to this. Look at the 2008 bull market. The top gainers, the most liquid stocks, the most widely held stocks are down 90 to 99%. You can look at Unitech. GMR, GVK, RCOM, Suzlon. And even today, when I see individual investor portfolios, I find those stocks in their list. What really went wrong? It's not that you intellectually failed. It's not that your models did not give you the triggers. It is your inability to pull the trigger. When someone tells you to buy, before the person has finished the statement, you have already called your broker and given the buy order. But when somebody asks you to sell, you say, wait, let me see. Let me give it a day. Let me give it a week. And giving one day extra, the damage that Mastech has caused me has never left me. So as I tell my friends very often, that I may miss a lot of winning opportunities, but I never ever miss an exit. Because each time the exit red light flashes, Mastech comes up, and I never fail an exit. In fact, this is the ultimate lesson in risk management, your ability to exit losers. You will see this especially with retail clients, this inability to book losses. And that is the first step in controlling risk and controlling risk of ruin. The second part is the booking of profits. Here also, what happens is that you get drunk with success. I will give you a case of a stock that I owned and which really felt to me is going to be a lifetime holding. This was in 2009. As I told you that pharma was the first sector to break out and I was logged into Sun Pharma. I rode the stock for multiple years. However, in 2016, what we started seeing was a bit of a wobble. And this was not just restricted to Sun Pharma. This was actually extended to many other stocks. You started seeing this whole US FDA problem. And not only did you start seeing a price damage, you also started seeing some bad acquisitions by the company and quarterly earnings started deteriorating. After 5, 6, 7 years of outstanding numbers, the numbers started failing. So the risk of ruin is, however good a stock it is, however great a stock is very high in our market if you do not have the discipline of exit. All these stocks I mentioned earlier, Unitex, GMRs, GVKs, RCOMs, were marquee names in 2008. Everyone had them in their portfolio. They could do no wrong. But if you did not have the ruthlessness to exit, you would be ruined in these stocks. So the exit decision, the challenge is one at the intellectual level, but more importantly, at the emotional level. And your biggest enemy here is the ego. Let me tell you my methodology for exit at an intellectual level. In the earlier framework, we have pulled out that how we see or look for stocks with accelerating earnings and accelerated price. In fact, interestingly, my model, whenever a stock gives me exit signals, you find deacceleration in both. This overlap is very, very important, and this is what makes it a superior system. You can just visit something as simple as the Dow theory, which is swing lows, and you will realize that this is a very good point of exit.
Now we've seen all of this, but how do you actually enter and exit? Let's find out. So what I'm going to do is I'm going to only open a chart and tell you the exit strategy. So let's start with Titan, because we've talked about Titan so much. The first thing you need to do when you open a chart, right? You need to make sure that you are using the monthly chart. All right. This is a long-term investing strategy. You have to use monthly charts. Now, once you have this chart here, we will follow the swing high, swing low approach. Very simple. As soon as two swing lows break, you are out. So as you can see in Titan, to understand swing lows, by the way, please take Tom Basso's course. It explains it really, really well. I'll just try to apply it over here. So let's start from 2009. Nice move up. If you still don't know when to buy the stock, I would suggest wait for two swing highs to break. So for example, let's suppose we are here in 2009. We have swing high 1 and swing high 2. And we break that here and here in just one candle. As soon as two swing highs break, you will enter. And as soon as two swing lows break, you will exit. So let's see where that happens. Market goes from 66 all the way up to 209, falls down. Look at that. That's a swing low break. It broke, but we won't exit because we need two swing lows to break. So we're still holding on. Another swing low broke here. It's only one swing low, so you don't exit. Still holding on, still holding on. That's a swing low broke, going sideways. And you see this red bar here? Let me zoom in. This red bar broke this swing low. So you had one swing low break and you had a second swing low break. As soon as this happens, you're out at 204 and you had entered somewhere here, right? Around 70. That's still a great return. And it took you only maybe 2 years to hold on to the stock. 2 years. Let's move on. Now you're out. Swing high break, you enter. Second swing high break and you enter here. Sorry. So first break, second break, that's your entry. Now in this case, swing low breaks 1, swing low breaks 2, you're out. You didn't make any money on this, but that's fine. Let's see the next example. Two swing highs broken, one here, you enter. Swing low 1 breaks, you hold on. This is scary because you entered and the market just fell, but you hold on. Market then reverses, luckily. It could have fallen and your exit would have been really low. But in this case, nothing happened, kept going up. And your exit would be here. So first swing low break, second swing low break, that's at 745. I know it's sad you didn't exit at the top, but what do you do, right? That's just the thing of system trading, but it's still a good return, right? Very good return. Again, first swing high break, second swing high break, that would be your entry. And if an investor had entered, he'd still be holding on, waiting for something else. Let's see another example. I will look at Kajaria Ceramics. So Kajaria is interesting because it moves a lot. So let's see, I'll just start from 2014 to make this a little easier. Somewhere, let's suppose you entered somewhere here. And you're holding on. I'm going to teach this exit. We don't have any swing low break. That's what I'm looking for. We have one swing low break here, but we're looking for two. Doesn't happen. No swing low break at all. First swing low break, second swing low break. Your exit is at 600, and God knows where you would have entered. I mean, you would have entered at a really low number. So that was a crazy trade. Very difficult to do also. Now let's see the re-entry. So swing high 1 break, second swing high break here. So that would be the entry, I guess. That's the swing high. I know it doesn't look like one, but it is a swing high. That's your second you've bought. And first low break, still holding on. So if it reverses and falls here, that will be your exit. Pretty big loss. Otherwise, it'll go up. Who knows? But that's the system. Let me show you one more example, say Britannia. The hang of this, that first swing high break, second swing high break, that's your entry, you're holding on. Swing low one break, you will still hold on, goes all the way up, swing low one break, swing low two, doesn't break, still holding on. Wow, that's you have to be really lucky to get into a trade like this, but if you do, it's just massive. Anyway, this big bar broke this swing high and this, which means you would have entered here. Now, if the market reverses, I mean, you take a loss, but according to the system, you're in and you're making a loss right now, but that's the entry point. I've taken nicely trending stocks. Let me show you one last example of a stock that doesn't trend well. So that's Colgate. At least right now, maybe it trends better in the future, but I have to show you a bad stock as well. So here it is technically. So we have an exit here, swing high one break, 1, 2. Okay, you would enter here because 2 swing highs broke. Your entry here, first swing low break, nothing. Second swing low break, exit, that's your loss. And let's see where the re-entry is. Swing high one break, swing high two break, entry, still holding on. So you see a lot of sideways here. You'll get many entries and exits. Sometimes you'll get a nice trend. But basically, use your filter to zero into the stocks. And then you can use the monthly charts, the 2 swing high low break criteria to enter and exit. Of course, you should backtest this. Of course, you should change it. This is just one framework for you to use. All you really need now is to execute and have tons of patience to actually do it, because the real money is made when you're sitting on the side and not actually analyzing. That's the most difficult part. Imagine holding Colgate here and holding on forever. That's a very difficult thing to do. If you can master that, that puts you in the top 1% investors in the world.
This combination or this togetherness or this coming together of both these variables really give you very good exit signals. Remember, if you do not exit, especially retail investors, you run the risk of ruin in this market. This market is ruthless in a down phase. When the market comes down, it comes down in an elevator. It is very fast. You have to be very fast to exit, and you have to be dispassionate. That has been my learning as far as the exit strategy goes. Very often when companies have a bad quarter or you have a little bit of a price correction, people ask that is it a correction or change in trend? So this differentiation is very, very important. You've got to ask yourself, whenever you see a deceleration in numbers or a certain price correction, what is the quantum? I'll give you an example. In 2018, we had an NBFC crisis. Let me compare 2 NBFCs for you. One is a Diwan Housing. Here you saw a company which had a massive price damage. There were events specific to this company, and you saw an all-around collapse of the whole Dow theory, and the stock started making lower lows, and this was happening with high delivery volumes. On the flip side, another casualty of this NBFC problem was Bajaj Finance. Bajaj Finance also was coming down. How I was able to bifurcate that this is a correction and not a trend reversal is because you realize one thing, that there was no damage in earnings. The wicket was still green. Also, as per the longer term Dow theory, you realize that the stock never made a lower low. And the delivery volumes was not substantial. And there was no specific development to this stock which made me pull out the red flag. So this is why I could sit through Bajaj Finance through the correction, and voila, what you had many months later is the stock turned around and went into a new high. However, Diwan Housing kept going lower. So it is this skill set that you need to be able to differentiate between a correction and a trend reversal, which is very important. As I said, I repeat that when you see a deterioration in all these factors confirmed with price and volumes, you know that this is a trend reversal. This is something, as I said, we saw in pharma stocks. This is something we saw in NBFCs, And this is what we saw in a lot of mid-cap stocks in 2018, that the quantum of fall, the decrease in earnings clearly gave you a sell signal, which meant that the trend has reversed. My core philosophy or belief, which is that this market is all about cutting your losses and letting your profits ride. In this journey, you will have winners, you will have losers. Just have the sense that wherever there are losers and you think there's a trend reversal, have the objectivity to cut it. Wherever there are winners, you may have corrections, however, have the patience to ride them. And this combination of cutting your losses and riding the profit will skew the risk-reward ratio in your favor. And this will be the path to wealth creation. This will be the path of compounding. This will be the path for mega trends. This experience with all these legends of the stock market has been a very, very rewarding experience. A person learns from two things. One is from books and second is from people. I've been fortunate to be associated with some of the legends of this market. And being associated with them has been a deep learning curve and has been instrumental in modulating my thought process in the way I invest in markets. I'm really happy to do this episode with LearnApp. What got me to doing it first is the wonderful guy Prateek. He's been so persistent and following up. But when I met him, I really got to like him. He's a very bright guy with so much energy. So I got doing this for a friend actually. However, when I got into this platform, I realized that this is an amazing collection of thought leaders who really go out and take a deeper dive into their subjects. I do a lot of investor camps, do a lot of investor initiatives. However, I find that most of the knowledge that I can share is very basic. Through this platform and its format, it gives me an opportunity to make a deep dive into my subject and explain what exactly I do. I wish Prateek and his team great luck in all future events and episodes, and I'm really happy to record this for LearnApp.